Hi, my name is Ahmed Mahiyan, and in this video, I'm going to talk about 5 different ways that you can grow your money completely tax-free in Canada. Now, the first one is the tax-free savings account, or TFSA. So this is the best way to grow your money tax-free in Canada. A tax-free savings account can be used for any purposes. So it can be used for your retirement, it can be used to fund your kids' education, or it can be used as an emergency fund. In a TFSA account, you can invest in stocks, bonds, ETF, mutual fund, GIC, or even savings deposit. So you can invest various kind of investment in a tax-free savings account. Unfortunately, most Canadians use it wrong. Majority of the Canadian population use tax-free savings account as a savings account instead of an investment account. One of the reasons for that is the way the government labeled that account, which is tax-free savings account. So when you are thinking about a TFSA account, you probably think this as a savings account, where in fact, in reality, TFSA account should be used to invest long-term investment which grows over time, and those growth are completely tax-free for you. So how much can you invest in a tax-free savings account? So starting in 2009, the tax-free savings account has an annual contribution limit. So anybody who was born in 1991 and before that, and they lived in Canada since they turned 18, has the full contribution room for the TFSA account. If somebody has a full TFSA limit, that limit is $95,000 as of 2024. Now, if you already have contributed in the previous year in your tax-free savings account, check your CRA website, which outlines the up-to-date balances of your contribution room that you are allowed to invest in your tax-free savings account in 2024. Now, most financial planner likes tax-free savings account because of its flexibility. Since the income from a tax-free savings account is not considered as income, it can be used to supplement your income, and this income will not conflict with your other income-tested government benefits like Guaranteed Income Supplement or GIS. Option number 2, your primary residence. So a profit in your primary residence is also completely tax-free in Canada. Let's say somebody bought a house for $1 million 10 years ago and it went up to $2.5 million after 15 years. So the entire $1.5 million growth in the house price will be completely tax-free for that person. As long as this property is the primary resident, the owner of the property does not pay a penny to the government because of this gain. And because of that, a lot of Canadians use their primary residence as a source of retirement income. So the idea is all the growth will be tax-free, and when they retire and needs to generate income, they sell their property for a profit, and those gains are completely tax-free. From that property sale, they invest their money and generate retirement income. This is why most Canadians have a significant portion of their net worth tied to their primary residence. Now, a lot of Canadians also have cottage beside their primary residence. Unfortunately, you can only select one property at a time as your primary residence. This rule is called Principal Resident Exemption Rule, and you can only claim one property which will be completely tax-free. So if you have a rental property, you cannot claim it as your principal residence because you are not living there, and any gain that you are generating from that rental property, you have to pay taxes on that gain. Number 3, life insurance death benefit. So the insurance payout on a life insurance policy is fully tax-free payment to the beneficiary. If a husband buys a life insurance for, let's say, $1 million and assigns his wife or his children as a beneficiary, when the husband passes away, that entire $1 million payout will be completely tax-free. Typically, the insurance benefit is paid within 30 to 60 days. Even though the $1 million death benefit is completely tax-free, when the beneficiary receives that $1 million payout and invests the money, any income that is generated from that $1 million investment has to pay taxes every year. Because as you know, CRA wants their cut. Because of the tax-free status of the life insurance death benefit, a lot of wealthy Canadians use life insurance policy to transfer wealth from one generation to the next generation in a tax-free manner. Typically, this is done through some sort of permanent life insurance policy. However, most Canadians will be better off investing in their registered account and growing their retirement assets. The number 4 option is First Home Savings Account. This is a new type of account that was introduced by the government last year in 2023, And the way the FHSA account works is any contribution that you are contributing in this account will grow tax free as long as you use that money to buy eligible property. So if you are saving money in that account, and let's say you invest $16,000 in 2024, and that money you are able to grow it to 25,000, that $9,000 extra profit that you made within that FHSA account will be completely tax free as long as you use that $25,000 to buy a primary residence. So, similar to a tax free savings account, you can invest in stocks, bonds, mutual fund, and all kind of other investment products within an FHSA account. To open up an FHSA account, you have to be at least 18 years of age, and you or your spouse cannot have a primary resident when you are opening this account. So every year you are able to contribute $8,000 in that account. And if you haven't contributed anything from last year in 2020, you are able to contribute up to $16,000 in 2024 because you can only carry forward 1 year worth of contribution room. Now, how should you invest your money in an FHSA account? Well, it depends on how much time you have before you purchase the property. If you just turned 18 and have 5+ years before you purchase primary resident, then you can take a little bit of more risk and grow your money faster. However, if you are actively looking for a property and you are investing in an FHSA account, you should be investing in a conservative way so that your money doesn't fluctuate when you need the money for the down payment. So a conservative way might be investing in GIC or maybe a little bit of short-term bond fund, which doesn't go down when the interest rate goes up quickly. Now, because FHSA account is such a new type of account, it's always good to check government website to get the updated information. And number 5 is lottery gains. So lottery winnings are completely tax-free in Canada. So if you win a $70 million jackpot, the $70 million jackpot will be completely tax-free. However, just like the insurance policy death payment, any income that you are generating from that lottery gains will be taxable. Let's say you win a $50 million jackpot and you invest that money in the stock market and bond or whatever, and that investment is generating $4 million a year, half of that money will be gone to CRA because, when you are making $4 million of income, 53% will go to the government. Now, this video is no way promoting you to buy lottery ticket because the odds of winning a lottery ticket is next to none, but still it has a non-zero possibility. And if you win a lottery, you know where to call for financial advice. Thank you so much for watching this video. If you enjoyed this video so far, make sure to subscribe so that you don't miss the future video.